We're connected to our first caller, who's Mr. Ramesh Dikshit, and he's on the line with us from the Belgaum district in Maharashtra. Hi, Mr. Dikshit. Good afternoon. How can we help you?
Good afternoon, please. Hello.
Yes, sir. Go ahead.
I am holding 60 shares of Mahindra and Mahindra. Hello. I am holding 60
Yes,
shares
go
of
ahead.
Mahindra and Mahindra at the rate of 845. Hello.
Okay. So I think there is a little connectivity issue. So basically, Mr. Dikshit has 60 shares of M&M, which he has bought at 845 and now needs advice on what he should be doing. Mayuresh, first to you. Within the auto pack, how is M&M placed? A good play for a retail investor?
Afternoon, Sumaira. So again, I think if you probably look at the entire problems which are besieging the industry right now, I think the semiconductor shortage is clearly creating a lot of havoc as far as volumes are concerned and the overall earnings estimate as far as this financial year is concerned. But if you probably look at the last quarter numbers and in the con call, what the M&M management had set forth over the next couple of years, I think it was a pretty solid commentary. So they're looking actually at a 15 to 18% kind of a CAGR, both in sales and EPS over the next couple of years. But a substantial part, I think 12,000 odd crores, so whereas the capex that they're putting through, 3,000 crores for the EV play, 3,000 crores for the farm equipment play, and 6,000 crores for the PV market, because they're expecting 9 models to come out over the next 2 to 3 years, 14 LCV models, and almost 36 to 37 tractor models in the next 3 to 4 years. So again, I think the expectation that one can bind is that over a longer period of time, if all these elements go through, looking at their delivery in the past as well, earnings momentum should continue for the stock. At the same time, I think the capex that they've planned out, I think if they're prudently going to allocate that over the next few years, and the EV side of the business, as that side starts growing as well, you might see normalization start happening in terms of reported numbers on the balance sheet. So I think at 12 to 13% EBITDA kind of levels can get maintained. At the same time, I think ROEs might start hitting over the next few years higher single digits. At the current juncture, my own sense is that because of all the factors related to semiconductors, volumes, price increases, the stock might consolidate. So I think the investor will have to have a lot of patience as the price strength as per the O'Neill methodology probably lacks. An alternate, I think, is something like Indian Energy Exchange. Our take is that the kind of monopoly that they have got at this point of time, if you probably look at the June press release, the expectation in terms of the real-time market doing exceedingly well, the day-ahead market as well as the green market, proactively, I think, providing them better volumes, and because of that, higher margins at 79, 80 odd percent, better ROEs, almost 700 crores or cash onto their books, diluting their stake in the cash exchange as well. So I think an alternate, because the price tag probably lags in M&M and would continue in terms of consolidation, can be India Energy Exchange.
The next query comes in from Mr. Shishir Upadhyay, and he's on the line with us from Gurgaon. Hi, Mr. Upadhyay. Good afternoon. How can we help you?
Good afternoon. See, I wanted some advice with respect to my portfolio. I have 2,000 Tata Motors shares, which I purchased at 206 rupees some months ago. I want to know if this is a good time to accumulate more at the current price, and also likewise for Happiest Minds, which I bought at 686, 1,600 shares. Is this a good time to buy more, or should I book profits? Can you please advise me on that?
Sure. Mayuresh, I'm going to come to you again first. Tata Motors, again, along the same lines as M&M, because, the chip shortage continues. And then Happiest Mind, a stock that has rallied 300% this year, sitting at a fresh 52-week high. I mean, bypassing peers despite having a fraction of the revenues. Is it worthwhile to remain invested?
So again, Sumer, I think on Tata Motors, right? I think all the issues that we probably discussed with M&M also relates to that. So I think the kind of update that they've probably given in terms of the second quarter hit also continuing, and the second half where recoveries probably might start coming through as these shortages and blips are taken care of. FY22 reported numbers will definitely come off. So I think the intact element in terms of FY23 numbers staying as they are with pent-up demand coming through, I think that should remain constant. The second thing is that this is a universal problem for the auto industry as a whole. So it's not related to Tata Motors or M&M. I think everywhere in the globe, whether it's General Motors, BMW, Toyotas, I think all cars are probably facing the problem. So the impairment hits probably will be given. But largely, again, I think if the investor has a medium term or a longer term outlook, I think he can very well hold on to the stock. Let it gain strength out of this consolidation phase in terms of price. And once it gains some significant amount of strength, leaving aside and beside all these worries over the next few weeks and months, I think that can be a better time to start accumulating more. When it comes to Happiest Minds, yes, I think the company is probably in the right sector because IT sector is buzzing. I think it's booming at this point of time. The numbers again in terms of the digital outlook that they've got, 96-97% in terms of digital revenues, 94% in terms of agile within that. Strong EBIT margins at almost 24-25 odd percent. You've got strong ROEs at 30 odd percent. But my own sense is that I think a lot of gestation in terms of future earnings outlook, and when you stack it up with the larger players or even the larger mid-cap IT companies, valuations have gone out of the zone. On the other hand, as well, I think as per the O'Neill methodology, I think it is way too extended from its 200 DMA, which is one more sign that the stock, if it corrects, can start correcting significantly. So my sense is that start taking money off the table, purely because in terms of extension from the 200 DMA and because of valuations going through the roof at this point.
Hi, welcome back to Your Stocks. We're now being joined by Nadeem Muhammad, who's on the line with us from Warangal. Hi, Nadeem. Good afternoon. What's your query?
Yeah, hi. I have a query on Bharti Airtel and Sadbhav Engineering. I have 580s. I have Bharti Airtel of 280 stocks at 580 rupees. And I have Sadbhav Engineering of 900 quantity at 85 rupees. Can you just give me the fundamental analysis on both?
Okay. Mayuresh?
Oh, absolutely. So I think for Bharti, I think it is obviously in a phase of consolidation because the entire sector itself is consolidating. So if you probably look at numbers, right, the data subscribers or the subscribers in general that they are adding, Vodafone clearly is losing market share. Jio and Bharti are obviously gaining market share at the behest of Vodafone losing their market share. Second, I think if you're probably looking at both their business verticals, the India wireless business and the India mobile revenue, I think that's almost 54-55% of their overall console revenues. There, I think the base has grown because the subscriber base itself increased. They're close to almost 325 million odd subscribers at this point of time, which is a very, very healthy sign. The second element, obviously, is because of the impact of IUC charges. Headline ARPU obviously declined to 145 odd rupees, but the expectation here is that over a longer period of time, as price hikes start coming through and because of the payments that they've got to make in terms of spectrum allocations, I think the net debt to EBITDA levels should remain constant, and if price hikes happen, I think they should start coming off, which probably will give them the valuation and the earnings comfort. The Africa business was stable, and therefore I think the entire focus, both in terms of wireless and the enterprise business for the African markets, I think that remains pretty solid and stable at this point of time. So yes, I think from a price construct perspective, I think it probably needs to gain a little bit of strength, like in the case of Tata Motors as we discussed. The other stock, Sadbhav, I think it's clearly lagging in terms of earnings, it's clearly lagging in terms of price. So both the EPS and the RS rating as per the O'Neill methodology has come off. My own sense is that alternate plays like a KNR Construction or a PNC Infratech, if you are intending to stay in the same space, probably look very, very good from a growth perspective. Stable order books, which gives revenue visibility over the next 3 to 4 years. Strong EBITDA margins, very, very strong balance sheet with minimal amount of debt. They're monetizing a few of their assets as well at this point of time, and strong EBITDA margins in terms of the projects at hand, which gives them the IRR that is required over the next few quarters as well. So I think the alternates to Sadbhav, Sumera, that we like are either KNR or PNC.
The next query comes in on from Minakshi Bhuvania, who writes to us from Mumbai. She has 2,000 shares of Union Bank, which she has bought at just under 39. She also has 800 shares of IDFC First Bank, which she has bought at 57.58. She's a long-term investor, now wants to know what she should do. Mayuresh, both banking stocks, what's the advice?
No, so for Union, Sumer, I think the problem is that it has a weak core profitability. So if you probably look at the earnings growth has remained extremely poor. Slippages were elevated for the quarter gone by. The GNPA ratio improved, but it is still at around 13.5%, and that's because of the write-offs that they've taken on their balance sheet. The second element also is that the kind of allocation that they've probably got to the SME portfolio. So I think the SME, MSME portfolio is where the pain probably in the markets will probably still persist in the aftermath of the second wave. And therefore, I think further provisioning might be required on their balance sheet, which means higher credit costs. So the NIMs have actually come off to 2.4%. But again, I think the interest reversals is something that probably aided them. Capital adequacy, specifically CET1 for Union Bank, is around 9.5. And therefore, it still remains on the lower side. So my own sense is that it probably looks weak at this point of time. And therefore, switching from this stock would probably make sense. Again, I think you can probably look at leaders within the cement space or piping companies, because that is where I think the earnings momentum probably continues. And that is where the earnings strength will continue in lieu of government expenditure probably coming through. For IDFC First, again, I think the expectations in terms of GNP is going up. I think they're inched up to 4.2%. And that is definitely one negative from a near-term perspective. But the entire aspect is that the restructured pool is just 1.25 to 1.3% of the overall advances. So I think as these slippages start coming down, as the reported GNPs start coming down, the expectation that they've structurally laid out in terms of ROEs hitting 1.4, 1.5%, ROEs 13, 14%, and they're very close to that because the NIMs have actually improved to 5%. You're seeing granularity in deposits coming through, and dividend yield probably still remains extremely strong for IDFC First at 4%. So yeah, shifting from Union Bank to leaders within the cement pipe companies, and he may hold on to IDFC First Bank at this point.
Okay, the next query comes in from Bhupendra Mehta. He has written to us from Ahmedabad. He says he has 65 shares of Bajaj Finance, which he has bought at a little higher than 4,700. He's a long-term investor and wants to know if he can book some profits at present levels, and also wants to know if Avenue Supermart would be a good idea at current levels. Mayuresh, finally to you on both Bajaj Finance, what he should do, and if Avenue Supermarts can be a good investment idea.
So again, if he's not in need of money, right, so where I think it's a solid franchise, Bajaj Finance. Yes, I think because of the pandemic, the numbers in terms of historical precedences that we've seen and the growth rates that they have achieved is probably coming on. But again, I think they are probably underwriting advances very smartly at this point of time. Secondly, I think in terms of the digitalization and the cross-selling of their platforms, I think that is happening at a very fast pace, which means the optimization on the EBITDA level should continue in the next few quarters to come. On the asset quality front, I think with durable loans expected to pick up steam in the second half, my own sense is that the GNPs, the worst is probably behind us. They've got a very strong balance sheet, both in terms of capital adequacy, as well as in terms of the provisioning that they carry on their balance sheet, as well as their credit ratings as well. So it's a solid franchise. You're not in need of money, hold on to the stock. Avenue, again, I think because of the second wave, what has probably come through, the expectation is that it might take some amount of time for the pre-COVID earnings to start getting reflected on their balance sheets. Valuations were never cheap for Avenue Supermart, never will be. Therefore, I think the entire perspective in terms of their business model, the reported EBITDA per square feet, the working capital cycle that they possess is very strong. But at this point of time, I'll wait and watch for Avenue Supermarts, but continue holding on to Bajaj Finance.